Well, hey there, great day. If you are looking to learn about the four main components of a mortgage or a home loan application, and you want to know just a little bit more than you did yesterday about this topic, then you are in the right place. Matt, the Efficient Finance Guy here, and what I want to share with you today are essentially the four main components of a home loan application. But stay tuned till the end because I'm going to throw in a fifth. And I think, personally speaking, here, this fifth component is the one that makes applying and getting qualified for home loan financing very different and unlike just about any other type of financing that you may need to pursue throughout the course of your life. So, simply here, there are four main components to a home loan application. Number one, and I have these in a very specific order that I'm going to share them with you because one kind of leads and builds upon another, so to speak. So, number one, credit and your overall credit profile. Now, I'm starting with credit very simply because in the context of a mortgage application and qualifying for a home loan, everything in your personal household financial profile, it essentially is looked at in totality and everything works together one with the other. But very specifically, as it pertains to the credit component, if your credit does not meet the minimum required credit score standards for whatever home loan program you may be pursuing, there really is no basis to continue the conversation at that moment. Now, a conversation certainly could be had as to what needs to be improved on the credit, what steps could be taken to improve the credit score. What items are out there that may be holding you back on your credit score, or what is just some recent, credit performance history that needs to be improved upon going forward. So let's assume we're talking about a standard Fannie Mae or Freddie Mac conventional home loan. You're looking to purchase a home, and that is the product that you're looking to pursue or that you're speaking with your lender about. Well, in regard to credit, when it comes to Fannie Mae and Freddie Mac conventional loans, 620 is the minimum required score to be able to be considered for a loan approval. So if your credit score is currently 619, there is nothing at that point to discuss beyond that. Now, granted, we could move to a conversation possibly about an FHA loan or other options in the market. But if we're talking about credit score requirements for a given loan program, if your credit score does not meet the number required for the program, the rest of your profile really does not matter at that moment in time. So your income level, the money that you have available or assets that are in your, investment accounts, why you're purchasing the home, what your intended use of the property is, all of the other main components within a home loan application essentially are irrelevant if your minimum credit score is not at or above what that required score is for the program. Now, just for an ounce of clarity here, in the world of mortgage lending, at this moment in time, and there are some possible changes forthcoming here in the very near future in the credit realm as far as it pertains to mortgages, but right now and historically, three credit bureau reports are obtained and they are merged together so we have a summary, comprehensive profile of what your credit scenario and history looks like. So the three main ones used in the mortgage lending industry traditionally have been Equifax, Experian, and TransUnion. Now, in the world of mortgages, what normally happens when looking at the credit score component alone, you are going to have three credit scores, one from each of those credit bureaus or providers. The middle score is the one that the transaction is going to be analyzed on and based off of for pricing and other details within that product. So you could have an 800, a 700, and a 600, and that would be unlikely. Typically, there's not that much of a range between those three major bureaus. But just for example purposes, If you were scoring 800 with one bureau, 700 with another bureau, and 600 with another, the 700 score is the one that would be utilized for the transaction. Now, don't mistake that with being averaged, because in that example, if you average those three together, 700 would be the score, but it is not the average that is taken into consideration. It is simply the score that is the middle score. And if there are multiple borrowers on the loan application, then the middle score of each of those borrowers is the one that's looked at, and the lowest middle score out of all the applicants on the loan is the score that is utilized for the transaction. Now, I have some of my own views and perspectives on this, and the spirit of this channel is not to necessarily give you Matt's opinion. But if you had 4 applicants on a home loan application and the middle score for 3 of them was 780, and then there was one applicant over here coming in at 625, the entire loan application is based off of the 625 over here. The different applicant middle credit scores do not get averaged. It just tends to always be the most punitive or the most restrictive from the standpoint of the credit risk analysis. So credit is component number one. And while the score itself at the beginning stage of having a conversation with a mortgage lender is critically important, because that credit score is the item that then determines where does the conversation go from there, we are also looking at the overall credit profile. Now, I don't want to get into the weeds and get too complicated on this, but with that being said, bear in mind that the information on your credit report, when you're looking over the entire profile and the accounts that you have and how long that you have had them, in some instances, you may still have some hoops to jump through or some hurdles to overcome, even if your score itself is above the required threshold. And one example of that might be you are very new to the credit world. So let's say you're younger, or let's just say you're even possibly older and just never really have needed to utilize credit. If you have 1 or 2 credit cards that have been open for 2 or 3 months and you're currently generating a 760 or 770 credit score, the score is wonderful, but the overall history on your report may not be deep enough, or there may not be enough time history tied to it to meet some of the lending industry requirements. And bear in mind that within this industry, change is eternal and ongoing and very regularly. So again, this is the here and now as of right at this moment. I'm recording this here in the fall of 2025. We're coming up this week on Easter. We're coming up on Halloween this week. So as of right here and now, there are some rules within the guidelines of Fannie Mae and Freddie Mac that do indicate what the overall depth and history of the credit profile might need to look like as well. Now, these instances are generally few and far between, and things have changed a lot over the last 25 years or so with the advent of automated and electronic underwriting, as opposed to files being analyzed and decisioned by a human being. But bear in mind, you want to have a bit of a balanced credit profile. You want to have some history in your credit profile, and you want that score to meet the minimum standards for whatever product or program you're pursuing. So that's going to lead me to item number 2. So with that being said, let's assume you're getting in touch with the lender, you're having that initial conversation, and the credit comes in, and the credit profile along with the credit score allow you to continue the conversation. So the next main component then, item number 2, would be employment, or I should say employment/income. So we're then going to look at, okay, what is your current employment situation? What is your employment history? Now, we don't need to necessarily dive into your employment history unless you have not been on your current job for at least 2 years. If you are on your current job for 2 years or more, then anything that you have done in the past, in just about 99% of cases, is going to be considered irrelevant. It's not going to be asked about. It's not even going to be discussed. Now, when your current job is less than 2 years in duration, we need to fill that 24-month window or 2 year window going back over the immediate preceding 24 months. So if you've been on your current job for 18 months and you'd been on a prior job for however long, assuming that it was more than 6 months, we would simply notate what that prior job was. And let's say you'd been on that job for 3 years. So between the current job of 18 months and at least 6 months prior, you were on your prior job. Then we have the 2 year employment history covered. Now, again, I don't want to get into the weeds or the guidelines or the details on what we are looking at when we are considering your employment history, the nature of your compensation. Are you hourly? Are you salaried? Do you have overtime? Do your hours vary where you might be then considered part time in the world of mortgage lending? There are a lot of little nuances. Do you receive bonuses? If so, have you been receiving them for at least 2 years? Are they guaranteed or are they based on performance? There are lots of variables that I will be covering in future videos, but for this one right here and now, I simply want to address those main components of a mortgage loan application. So we have credit and then we have employment/income. The third component is going to be assets. So let's just assume that you're in that conversation with a lender. The credit report has come in. We know the credit score is above required standards. We know that your trade line profile or your credit history depth is satisfactory, that an approvable recommendation should be achievable. We then move on to the employment. And for the sake of this video and this conversation, let's just say you've been with your current employer for 2.5 years and you are salaried, making X amount of dollars a year. So we know that we can use that income in totality. Whatever your annual salary is going to be divided by 12. We're going to use that as your monthly income on the loan application. And that's going to be one of the main numbers that influences and helps determine how much home you can afford. So how high can your monthly housing payment be? And that is going to be driven by how much income is coming into your household and able to be verified and documented, through pay stubs and W-2s and tax returns in some cases. So now we know that you have employment history that is satisfactory. You have an income type that is satisfactory. So the third component is going to be assets or money in the bank. Now, in the world of mortgage lending, the industry over the years, because of the nature of the dollar volume that is present in real estate transactions, the industry has been used in money laundering attempts. Some successful, some not successful, some successful with people caught later and prosecuted. But I bring that up as to help you understand why it is that mortgage lenders get so, what's the right word? Analytical, I should say, in reviewing asset account statements, bank statements, investment account statements, because they're looking for unusual activity. So from the legislation that governs this industry, the Patriot Act, anti-money laundering efforts, anti-terrorism efforts, looking at bank statements is simply a way to validate that assets being brought into the real estate transaction when a mortgage is involved are legitimate and legal funds. So there are some tolerances and thresholds here, but when a lender is looking over your bank statements, and let's just say for an example that you make $6,000 a month. Well, throughout the course of a month, whether you're paid weekly or biweekly or monthly, we are going to see, and in most cases in this day and age, a direct deposit reference from your employer with whatever your net take-home pay is per pay period. So if you make $6,000 a month and there was a random deposit of $200 because your grandmother sent you a check for your birthday a few weeks ago, that is not questioned. That does not need to be addressed or dealt with. I don't want to get into, again, all the guidelines and the details and the tolerances here. But for example, if you earn $6,000 a month from your job, you have no other income sources disclosed, you don't have a side hustle, you don't have any part time work, and in a given month's bank statement cycle, there just happens to be a random $4,000 or $5,000 deposit that we're seeing in that bank statement cycle. That is going to need to be addressed and discussed and documented and paper trailed to make sure that the source of that $4,000 or $5,000 deposit is legitimate and legal and not from any sort of illegal activity or questionable source. There are a bunch of other rules and regulations that go into that, but let's just assume, in the spirit of keeping this video moving forward, that we've covered your credit, we have covered your income and your employment history. Let's say you're looking to purchase a home and you're going to need $30,000 to purchase this home between your down payment, your closing costs, all the transactional items involved. And we look at a current checking and savings account, and over the course of the last 2 months, we see that you maintain an average balance between those two accounts of somewhere around $35,000 or $40,000. Everything is fine. We can move on to the next step in the conversation regarding the items that are on a loan application. So in this case, we're moving on to item number 4, which is, what is the intended use of the property and the spirit of why you're applying for the financing. So in that context, we're then going to be looking at, are you purchasing this home as your primary residence? You're going to be moving into that property full time. You're going to be updating your driver's license. You're going to be filing your income taxes from that address, your true primary residence. Or are you looking to purchase this home as a secondary residence for yourself? So in the case of a secondary residence, you can consider this like a vacation home. Now, there's, again, lots of rules and regulations that I could digress and start talking about, but ultimately a second home, it doesn't necessarily mean that it is the second home that you own. It simply means that it is a secondary residence. So you could have more than one second home. So you could have a ski lodge in Colorado and you could have a little beach getaway in the Florida Keys. Both of those are secondary residences where you spend some portion of your year utilizing that property essentially for your own personal use and relaxation and enjoyment. So bear in mind that secondary home does not necessarily mean home number 2. It simply means that it is a secondary place that you spend some of your time, but not more time than where you spend in your primary residence. So you could also be purchasing the property as an investment, and whether that is to turn it into a long-term annual lease, whether that is to utilize it for Airbnb, whether that is to rent it most of the year and maybe spend a little bit of time there here and there, whether you're looking to purchase it and spend a little time fixing it up to then put it back on the market to resell it for a profit. If you are looking to purchase it as an investment or a rental, then that is basically the third category. So you have primary residence, second home / vacation home, or non-owner occupied / rental. So in the case of a rental property, in most instances, you are not going to be spending any of your time there personally. So those are the 4 main components that are analyzed within the context of a home loan application. Now, all of them are looked at in totality because depending on what you are intending to do with the property, that could trigger a higher minimum credit score requirement, or it could trigger a higher minimum down payment requirement. If you're looking to buy it as a primary residence, you're generally going to have the lowest credit score requirement that needs to be met. You're going to have lower down payment options. So each of those items are going to be reviewed in totality, but they're also going to be looked at in standalone capacity, so to speak. And what do I mean by that? Very simply, if your credit score does not meet the minimum required, again, regardless of what your income level is, regardless of how much money you have in the bank, how many assets you can verify, or how much you're looking to put down on a property, if your credit score does not meet the minimum, we need to work on getting that fixed so that we can move on in the conversation. Now, conversely, let's say you're dealing with an exceptionally high credit score. You might be walking into this and your credit score is coming in at 830 or 840, or maybe even maxed out almost at 850. The excellent credit score is excellent. And if that would apply to you, then congratulations on doing a fantastic job managing your borrowed money obligations. However, if your income does not support the mortgage payment for, let's say, the home that you would be looking to purchase, the fact that you have that exceptionally high credit score really doesn't mean that the conversation can continue. We've overcome step number one, which is the credit, but now we get to the income and employment part. And if that income level is inadequate relative to the thresholds the industry has in place for qualifying and analyzing what you can afford, then the fact that you have that really strong credit score does not override or supersede that your income is not sufficient for the transaction. So another example of this, just very quickly, you might have an exceptional credit score. You may have exceptional earnings. All your numbers look great. Your housing ratio is great. The credit score is great. Your housing ratio relative to your income are all absolutely A plus from a risk assessment perspective. But if you don't have enough assets in the bank to cover the down payment needed to purchase the home, then those first two items being exceptionally high cannot override the fact that you simply need to save more money or possibly inquire, getting a gift from a family member or going about that in another way. I could talk about that for hours, and that's not the spirit of this. I want to get to number 5. And this is the item where things get very different than what most people experience when they're borrowing money elsewhere. And that is the overall debt ratio tied to you as an individual. Now, your personal circumstances and what you bring to us as a lender are going to determine what your debt ratio is. So I'll give you just a very generic and simple example here. So let's say that your income is $6,000 per month. Let's say that the home you are looking to purchase is going to carry an all-inclusive monthly payment, so principal, interest, taxes, and insurance, and that is going to be $2,000 a month. That is an absolutely acceptable ratio or proportion of income relative to the cost of the home. Payment is $2,000 a month. You gross $6,000 a month. So your housing ratio is coming in at basically 33.33%. But where things get a little different, and this is in stark contrast to how apartment complexes and rental lease agreements are generally going to look at things for qualifying. Based on conversations that I have had with clients and to my general knowledge of the rental market side of housing, I believe that an apartment complex is simply going to look at what is the cost of the apartment and what is your income. And they basically want that to be that your income is 3 times the amount of the monthly rent. So if an apartment's going to run $1,500 a month, they simply want to see that you make $4,500 a month. And as long as whatever their minimum credit score requirements or thresholds are, you meet that, you're generally going to be able to move forward as long as you can come up with that deposit or maybe a first and last month's rent or whatever they're doing at that point in time. I don't believe, and again, to my knowledge at this moment in time, I do not believe that apartment rentals or rental lease agreements, when they look at evaluating you as to whether or not they would want to offer you terms for that rental, I don't believe they get into the equation of your other debts. And that's where in the mortgage industry, this can be very problematic. So going back to that initial example of $6,000 a month in earnings and a $2,000 monthly housing payment, again, very qualifiable, very approvable all day long, assuming all other variables are in line and good to go. So you have a 33.33% housing ratio in that example. Well, if you have a car payment and you have a few credit cards and you have maybe a couple of student loans out there, let's just say, for the sake of this example, that those items are coming in at $1,000 a month. Well, in the mortgage lending industry, where your overall debt ratio is arrived at is by taking the cost of the home you're looking to buy. So here we are with the 2,000 a month, and then we have to layer on top the minimum required payments for your other obligations. So in this example, with those other obligations being $1,000, you now have a housing payment and other obligations that are totaling $3,000 a month. And as compared to your income of 6,000, that debt ratio is now 50%. Now, in the case of an FHA loan or a VA loan, that may still very well be an approvable scenario. But in the case of a Fannie Mae or a Freddie Mac conventional loan, if your debt ratio exceeds 49.99%, again, as of the time of recording, that loan is not going to achieve an approval recommendation when we push it through the electronic underwriting platform. So that debt ratio component really comes into play depending on all the rest of the story of what's going on in your life as far as your other debts. In the example of the 2,000 a month for the house and 6,000 a month of income, if you have a credit card with a minimum payment of 100 and a car payment of 400, well, now you have a house plus those obligations, you're at 2,500 against $6,000. You are below 50%, and in most instances that's going to be very approvable. And when you look at these numbers, it's all very specific and custom to you, because your income is your income, your earnings are your earnings. The area that you live and the cost of housing there, how much you have to put down and how much you need to borrow to secure the property that you're looking at is going to influence and determine to some degree what your overall housing obligation is going to be. So if you have a debt ratio, let's say in this example, again, the other obligations are 1,000, the house is 2, and when you combine them together, you're sitting at 3. Well, to make that an approvable scenario, either we need to reduce the debt level so that that is below 50%, or you need to earn more money so that it's below 50%. Or if those two options are not viable, you would need to scale back a little bit so that that housing payment now drops. So in the case of this example, let's say you could scale back on how much home you're looking to shop for, and you can get that housing payment down to 1,900 per month instead of 2,000 per month. Well, now 1,900 plus the 1,000 of other obligations puts you at 2,900 per month in total, divided by your 6,000 a month of income. You are now going to be, albeit close, just below that 50%. And the chances of that scenario being approvable for you are going to be much greater than if it's at 50%, where it's basically almost always going to be an absolute and immediate ineligible for approval. So those are my 5 main components when it comes to mortgage financing and a home loan application. If you enjoyed this video, please feel free to share this with anyone else that you feel could benefit from this information. And if you are ever in need of mortgage financing for a home or a condo or any other type of property, even if it's a unique property by local standards or whatever may be, anywhere in the state of Florida, or even if you simply have a mortgage related question, please do not hesitate to reach out. I would be more than happy to address your questions and help you and guide you in any way possible. If there are any future topics that you would like to see me cover on this channel, drop a comment down below and I would be more than happy to see if I can create a video to address your question and then be able to share that on this channel for the benefit of everyone that may be able to see it. Make it a great day out there. Thanks for tuning in, and I look forward to seeing you in future videos. Matt, the Fish and Finance Guy, checking out. Take care and make it a great one. Well, hey there, if you are still with me, I am truly hoping you enjoyed the content within this video. I hope you found it informative, and I hope that I shared it in a way that it brought benefit to you and made the most sense to you possible. If you would like to be notified of future content when it becomes available, go ahead and like this video and subscribe as well. If there is anyone that you may know of in your friends or family circles that may enjoy this information as well, or is possibly going to be in need of mortgage financing in the state of Florida at any point in the future, whether that's 2 months, 2 weeks, 2 years, please feel free to go ahead and share this with them. I appreciate you being here. And if you have any topics or ideas that you would like me to address in future videos, go ahead and comment down below. I would be more than happy to see if I could address your comments or requests for the benefit of everybody. And whether or not you need mortgage financing, possibly in the future, if you are considering relocating to Southwest Florida or anywhere in Florida for that matter, feel free to jump over and check out my Life in Southwest Florida YouTube channel. There is a link to that down in the description below at any point. If I can be a resource for you, if I can answer any questions that you may have, or if there's anything that I may be able to do for you, please don't hesitate to reach out. I look forward to connecting with you, and I look forward to seeing you in future videos. Take care and make it a great day.